Hey everyone, welcome back to Corporate Decoder. Today, Boot Barn Holdings Incorporated just filed their quarterly report for the 27th of June 2026, and there are some interesting moves to unpack. Quick note, this is not financial advice, just my take on public filings for educational purposes. Boot Barn saw a solid jump in sales and profits, but a closer look at their numbers reveals some interesting dynamics that might shape their future. So let's dive into this. This is Boot Barn's Form 10Q, which is a regular update that public companies file to share how they are doing financially over a specific period. This one covers the 3 months leading up to the 27th of June 2026. First up, let's look at their balance sheet. Think of this as a snapshot of what the company owns and what it owes at a specific moment. As of the 27th of June 2026, they had total assets of about $2.57 billion. That is up from about $2.45 billion at the end of March 2026. A big chunk of their current assets, which are things they can easily turn into cash, is their inventory. It stands at over $900 million in June 2026. That is up from around $844 million in March. This tells us they are stocking up on goods, which is usually a good sign if they can sell it all. Now, a unique item here is their right-of-use assets, which come from their leases for all those stores. These are valued around $667 million. This is important because it shows the long-term commitment they have to their physical store footprint. On the other side of the coin, total liabilities stood at roughly $1.21 billion. This is up from about $1.13 billion earlier in the year. While it is not alarming, it shows they have significant obligations to cover. Stockholders' equity, which represents the owner's stake in the company, is about $1.36 billion this year, up from $1.31 billion. This growth is a positive sign indicating the company is building value for its shareholders. Now, let's move to the income statement. This tells us how much money they made and spent over a period. Net sales jumped significantly to $593.5 million in the 13 weeks ending the 27th of June 2026. That is a healthy increase from $504 million in the same period last year. This is the bottom line growth we often look for. Gross profit, which is what is left after subtracting the cost of selling their goods, also saw a nice boost to $239.9 million from $197.2 million. This means they are managing their costs effectively or selling at better prices. However, selling general and administrative expenses also went up to $149.4 million from $126.5 million. This is expected as they expand and operate more stores, but it is something to keep an eye on. The good news is that their operating income, which is profit from their core business operations, increased to $90.5 million from $70.7 million. This shows their sales growth is outpacing their increased operating costs. And finally, net income, the profit that is left after all expenses and taxes, soared to $70.1 million from $53.4 million. That is a strong performance indicating a healthier bottom line. Interestingly, the number of shares outstanding for calculating diluted earnings per share went from about 30.75 million to 30.6 million. This slight decrease in shares means that the earnings per share growth is even more impressive because the profit is spread over fewer shares. Looking at the statement of stockholders' equity, we can see the changes in the company's ownership structure. Retained earnings, a key component of equity, shows a healthy increase to nearly $1.2 billion. This means the company is successfully reinvesting its profits back into the business. Also notice the treasury stock balance, which represents shares the company has bought back. It increased, meaning they likely continued their share repurchase program to boost shareholder value. Now, for the cash flow statement, this is crucial because profits on paper do not always mean cash in the bank. Net cash from operations was $83.8 million. This is generally a very strong number and shows the business is generating good cash flow from its day-to-day activities. On the investing side, they spent $51.1 million on new property and equipment. This is likely for opening new stores and upgrading existing ones, a key part of their growth strategy. Financing activities show they used $34.5 million. A significant portion of this was for repurchasing stock, which, as we saw earlier, is a way to return value to shareholders. Digging into the notes, we get more context. Boot Barn operates as a single reportable segment. This means they don't break down their financial results by different product lines or geographical areas because their business is so integrated. Their inventory valuation policy is pretty standard. They use the lower of cost or net realizable value. This just means they write down inventory if its value drops below what they paid for it. The company follows the newer lease accounting rules, which means their operating leases for stores are on their balance sheet. They have significant right-of-use assets and lease liabilities reflecting their extensive store network. Their stock repurchase program, authorized in May 2025, allows them to buy back up to $200 million of their stock. They've already repurchased over $25 million in the period we are looking at. This demonstrates a commitment to shareholder returns. A notable item here is the recognition of $17.3 million in tariff refunds. This is a one-time gain that boosted their reported results for this period. It came from a Supreme Court ruling on tariffs. As mentioned, Boot Barn operates as one segment. This simplification helps management focus on the overall performance of the company. They are breaking down their net sales by merchandise category, showing footwear is their biggest seller at 47% of sales, followed by apparel at 36%. Accessories and other make up the rest. And by channel, they are heavily reliant on stores, making up 92% of their sales, while e-commerce is only 8%. This highlights the importance of their physical presence. Goodwill, which represents the premium paid over the fair value of net assets when acquiring other companies, remains stable at $197.5 million. No impairment charges were recorded, which is good news. Their revolving credit facility with Wells Fargo was increased to $500 million and extended to 2031. This shows they have strong banking relationships and access to capital for future growth or needs. Currently, they have no outstanding loans on this facility, and the interest rate is about 6.8%. This is also a positive sign of healthy finances. The company uses stock options, restricted stock units, or RSUs, and performance share units, or SUs, to compensate employees. Total stock-based compensation expense after tax was about $3.5 million. This is a significant cost, but it is a common way to attract and retain talent in the retail industry. Their earnings per S-Hair figures are quite impressive. Basic earnings per S-Hair was $2.31, close to last year's $1.75, and diluted earnings per S-Hair was $2.29, up from $1.74 last year. This shows strong profitability on a per-share basis. A significant subsequent event is the amendment to their credit agreement that we mentioned, the increase and extension of their credit facility. This is a big win for financial flexibility. Moving into the management discussion section, this is where the company explains how they see their own performance. They highlight that net sales increased nearly 18%. They credit this to new stores and strong same-store sales growth. Same-store sales, which track sales in stores open for at least a year, increased by 4.7%. Gross profit grew even faster at over 21%. This was helped by a $14.7 million tariff refund, which means part of that profit boost was due to a one-time item. But even without that, the underlying merchandise margin improved. SG&A expenses increased, but by a slightly smaller percentage than sales. This means they are managing their operating costs effectively as they scale. Income from operations improved, and as a percentage of sales, it went up to 15.3% from 14%. This is a sign of improving efficiency and profitability. Net income saw a substantial 31% increase driven by higher sales, a better gross margin partly due to those tariff refunds, and controlled operating expenses. The store operating data shows they had 566 stores open at the end of June 2026, up from 473 the previous year. This aggressive store expansion is a key part of their growth strategy. Looking at cash generation from operations, it was very strong at $83.8 million. This indicates robust business health. Financing activities show they spent nearly $25 million on stock repurchases, which is a focus for returning value to shareholders. Finally, in the exhibits, we see the official certifications from their CEO and CFO confirming the accuracy of this report. They also list the amendment to their credit agreement as a key document. So what is the overall story here? Boot Barn is growing, sales are up, profits are up, and they are generating healthy cash flow. Their aggressive store expansion is clearly a driver of this growth. They also benefited from a significant tariff refund which boosted their margin this quarter. The key risks, though, remain around consumer spending and the continued success of their expansion strategy. Will those new stores perform as expected, and can they maintain healthy margins, especially with ongoing inflationary pressures we heard about earlier? The increased credit line is a plus for flexibility, but the core of their success will still hinge on selling those boots and apparel effectively. Alright, that is my take. Stay decoded. If you want the broker and charting tools I mentioned, they are in the description affiliate links that support the channel.